firm based out of Glendale area since 1971. This is just a picture of our building in Glendale. Bob started off preparing taxes in the early 70s and put two things together fairly quickly, that the real estate industry and the tax industry, they kind of go hand in hand. The largest tax write-off that you and I as investors will ever own or have as a deduction on our tax returns are pieces of property. Either the mortgage interest, which is a pretty sizable write-off if you have debt on attached to the property, or the depreciation on the actual property itself if it is a long-term investment property. So speaking on that side of things, so we actually at Robert Hall & Associates, we help to structure the tax return for investors, help agents, brokers, and developers pretty much increase cash flow through their investments, as well as maximize any deductions they might have throughout the year. So just really briefly talk about the 5 top tax deductions for realtors. I'm sure that everybody's really excited to hear about these things. Moving into 2014, as a self-employed individual, you have to understand one thing before anything else when you get ready to file your tax return. As self-employed investors or as self-employed individuals, the understanding of the Internal Revenue Code is that essentially everything except for mileage and meals and entertainment can potentially be a dollar-for-dollar tax deduction. Now, at the end of the day, when you talk about mileage and the IRS asking for a mileage log at the end of every year, first of all, anybody in the room not own a car and just drive their or ride their bike to work? That's pretty funny to think about, but I mean, it's a serious question. Mileage is probably the #1 tax deduction for people who work within the real estate industry. You are driving everywhere. That's how you operate your business, by going from location to location. So when it comes down to proving this expense to the Internal Revenue Service, they're going to ask for a mileage log. Now, the mileage log can be either handwritten, it can be an Excel document, it can be an application that you downloaded on your tablet or your smartphone. It doesn't matter how you provide this information to the IRS or in what shape or form it comes in. And the fact is that at the end of the day, the government is going to allow you to take a certain cent per mile in write-off. Usually it's about 55 cents per mile that you get to take as a write-off. So let's say that I have 10,000 business miles as a deduction last year. I get a $5,500 write-off for those 10,000 business miles. Now, my commuting, I live in Pasadena, I work in Glendale. When I leave my house in Pasadena and I drive to Glendale, my commuting mileage is not tax deductible. But once I get to my office location, and anytime I leave my office to go visit a property or to go visit a potential client or a current client, that is all deductible business mileage. And so that right there, if you add it all up over the course of the last 365 days, the IRS would give you 55 cents per mile. Now remember, mileage and meals and entertainment are the only 2 deductions that are essentially limited for self-employed individuals. So when you talk about some other deductions, we talk about legal and professional fees. That is not limited by any means. So when you go and pay your accountant to file your tax return, when you go and pay your financial advisor to set up a solo 401k or a SEP IRA or a traditional or Roth IRA, all of those fees to your professional providers are dollar-for-dollar tax deductible against your 1099 commission income, right? So make sure that you're taking those necessary write-offs. Now, when you talk about travel, you probably have a little bit of airfare, lodging, rental cars, maybe some meals and entertainment while you're traveling overnight. You have to be very careful with this particular write-off when you're looking at your tax return. Of course, everybody wants to bulk up their expenses and essentially lower their liability as much as possible. But when you talk about travel, let me give you an example, for instance. If I take my family to Hawaii, all right, that is the #1 vacation destination spot for people who live here in California. So when I write off my Hawaii trip, if I put $6,000 as my Hawaii trip expense and I try to fully deduct it on my business return, and the government questions me, they're going to wonder, first of all, what were you doing in Hawaii that was quote-unquote business related? Number 2, who went with you on that trip, or was it just $6,000 for you to travel to Hawaii and back? So if I take my family and I have 2 children and I have my spouse, and let's say that my children and my spouse have nothing to do with my real estate business, I have to limit this particular write-off. Now, a portion of my travel may be tax deductible because I'm a realtor and technically my job can take me anywhere in the world to view real estate. So if I want to take a portion of my trip as a deduction, I have to create some sort of paper trail or have some sort of proof that while I was there in Hawaii, that I actually viewed properties or talked to local real estate agents on whatever island that I was visiting. So if I go to the main island of Hawaii and I shoot an email to a local real estate agency and say, hey, listen, I'm interested in viewing some properties while I'm over there, can you send me a couple emailers? If I stop by, if I'm driving through a neighborhood in my rental car and I see a couple houses for sale, I pick up a couple flyers, that's proving to the IRS that while I was there, I was actually looking at property. This is my main source of income. This is my industry that I work in. So my children's airfare might not be deductible, my spouse's airfare might not be deductible, their lodging, their meals and entertainment, a lot of that might not be a tax write-off. But at the end of the day, how can I take a portion of my travel expenses as a particular write-off? Now I'm using Hawaii as an example, and obviously we'd all like to go to Hawaii and be able to write off a full vacation, right? But when you travel anywhere in the United States, that's the mentality that you have to have. You have to think, okay, if I was ever questioned about this deduction, as to whether or not the write-off is ordinary, necessary, and legitimate on my business return, how would I be able to prove that to the Internal Revenue Service? And they would look for flyers and emails and things like that to essentially show and prove why you were doing business on that particular trip. Now, that's a pretty gray area of the code, because nowhere in the Internal Revenue Code will they tell you that you can write off a vacation. In fact, vacations are personal time, they're personal expenses. But as self-employed individuals, I know more than anybody probably in the room that as self-employed individuals, you're always working and everything potentially could be a tax write-off. And so when you travel, make sure that you're taking advantage of these particular parts of the Internal Revenue Code. Now, living in Southern California, we understand that meals and entertainment, big tax write-off at the end of the year. It's an important part of doing business as well. So when I told you about the two things that are tax write-offs that could potentially be limited, we talked about mileage and meals and entertainment. Meals and entertainment automatically has a 50% limitation on it. So if I take a client out to dinner and I spend $200 on the bill, and let's say that I just order a glass of water and a salad, my meal might only be $10, right? But the bill overall is $200 to entertain this client. The government gives me a $100 write-off for that $200 bill. It's a 50% limitation. They assume that the 50% that you're taking as a write-off is for your client, and the other 50% is yours. Well, yours is not tax deductible, you're half of the meal, but your client's is. So let's say that I order 75% of the tab and my client only orders 25%. It's still a 50% limitation on the meals and entertainment write-off. Now I do taxes in all 50 states. And so some of my clients in other states, let's say in Texas for instance, they think that everybody from California is Hollywood. That's a general misconception, that everybody from Southern California is from Hollywood. All right, so meals and entertainment, when the IRS, when the Internal Revenue Service in Ogden, Utah, looks at your tax return, they might have the same mentality. So they're going to expect meals and entertainment to be a sizable write-off for you. This is an important part of doing business. So don't feel like you have to short yourself on this write-off. Don't feel like you have to limit it. Just make sure that at the end of the day, it is an ordinary, necessary, and legitimate write-off. In fact, those three things are what the IRS looks for in every tax deduction, for a deduction to be ordinary, necessary, and legitimate. If you can make the argument and answer yes to all three of those questions, if asked, you won't have any trouble taking that as a potential write-off or as a dollar-for-dollar deduction. All right, so remember that. Advertising, production development, television promoting, social media, social networking, all of these expenses are not limited. They are dollar-for-dollar deductible. So if I sign up for an online subscription for my business, dollar-for-dollar deductible. If I pay for a website or domain fees, dollar-for-dollar deductible. It's just like as if you printed business cards with your company's name on it and your name. That's an advertising expense. That's a promotional expense. It's promoting yourself. So dollar-for-dollar tax deductible. Do not limit this write-off on your individual business return or even your corporate return if you're incorporated. Now, if you get something in the mail that says this ugly red word, or this ugly printed out red word or stamped, to tell you the truth, the IRS doesn't even use this word anymore because it's so scary. They've created such a mess around this particular word, this audit word, that the IRS chooses not to use that when they send a mailer out to a client that they're potentially questioning. It's called a correspondence report. And the correspondence report is an audit. They just don't use the word anymore. California uses it on a couple of their forms, but only to audit people who are falsely claiming head of household filing status. They'll use a head of household audit letter. But the IRS doesn't even use this word anymore because they know that it scares people. And what scares people probably isn't going to be responded to in a quick time, so to speak. When people get these letters, they probably set them on their countertop, it sits under a stack of mail for months and months on end, and by the time they get to it, it's already too late and the IRS has already closed out the audit and assessed tax. But if you get something like this, do not procrastinate. Send it to your accountant as soon as possible. The worst thing that you can do is wait. As soon as your accountant touches base with the IRS and develops some sort of strategy to either get it paid off Or maybe it's a falsely assessed liability. As soon as you get that revoked from your account with the Internal Revenue Service, the better off you are. You do not want garnishments on your wages. You do not want liens on your bank accounts. That's the worst thing that you could ever have happen to you as a small business owner, especially if you were applying for home loans or SBA loans, small business loans. So make sure that you're taking care of that in a quick fashion. So what is the most audited real estate investment deduction? You can just shout out if you think you know the answer. Home office. Very highly audited deduction on a business return, but not the thing that I'm looking for. Anybody else? You can just shout it out. I know it's kind of early. Marketing it runs about probably a 40 or 50% chance of audit, that particular write-off.
Referral fee.
Rental.
Referral fees?
Yeah.
Referral fees, about 40% probably, but not the most audited part of a business return. This is actually a little bit of a trick question, and I'm sorry for doing that to you this morning. It's not an actual deduction that I'm looking for. It's actually the reporting of your gross income. As a self-employed individual, the first thing that a government agent asks for in any audit is 12 months of bank statements. They ask for those 12 months of bank statements because they want to make sure that all of your business deposits into your bank account equal what you are reporting as gross income on your individual tax return. Now, most of the people in the room today will probably receive a 1099 to show how much they've made throughout the year. But let's say that I am questioned by the IRS and I have $500,000 of deposits into my bank account, but I'm only reporting $300,000 of gross revenue in my business. Well, if I'm questioned and the government sees $500,000 of deposits, but I'm only reporting the $300K, they're going to ask you, well, where did this additional $200,000 come from, right? Do you might have some explaining to do at that point?
Yes.
Yeah, you might have some explaining to do. And that kind of explaining, you never want to get to that questioning area of an audit. You don't want the government assuming that you're underreporting income. So if you are inheriting money from a family member, or let's say that your spouse runs a small business on the side and you kind of share a business bank account, you want to make sure that you are separating your business income from all of your other income. Whether it's an inheritance that's non-taxable or a loan that you loaned a friend or a family member and they're just paying you back, you want to separate business income and personal income as much as possible. You do not want to have to be questioned by the IRS as to whether or not you're underreporting, or they're not going to question you if you're overreporting income, right? They're after you if you're underreporting, so you don't want to have to try and explain why that is, all right? So it's actually the gross income. But we talked about the in-home office. This form, this particular form on your individual tax return runs about a 75% chance of audit. 75%. And it's all because the government does not believe that you work from home. They believe that you actually have an office location. So be careful with this write-off. Be reasonable with the write-off. If you have a 2,000 square foot home and you put 1,000 square feet for your in-home office deduction, that's 50% of your home, meaning that 50% of your rent would be a deduction, 50% of your utilities would be a write-off, 50% of your mortgage or your property taxes would be a write-off to your business, and the government will probably flag you for that, because 50% is not an ordinary, necessary, and legitimate percentage of your overall square footage of the home. Now, if you take 15, 20, maybe even 25 or 30%, that is more reasonable. But be careful with these percentages because the government does look at that. 75% chance of audit just on this one form. Number 2, meals and entertainment. Remember that the government is limiting you 50% automatically. So meals and entertainment still has a little bit of a risk of being audited, but not as much as the in-home office, because the government's winning to begin with. They already give you a 50% limitation. So once again, be aggressive with this, but not overly aggressive. Be safely aggressive with the meals and entertainment write-off. When you talk about furniture, computer equipment, cell phones, fax machines, laptops, pagers, printers, GPS systems, filing cabinets, shelving units, desks, chairs, anything that's a furniture or a piece of equipment can be a dollar-for-dollar deduction for you as a business owner. When you think about going out and buying a laptop, let's say I go out and I buy the nicest MacBook I can find, spent $2,600 on the laptop, but I needed it for organizing my business information, for downloading QuickBooks, for downloading certain applications and certain software programs that help me develop my business and grow my business. That is a dollar-for-dollar deduction to you as a business owner. However, you have to make an election to take it as a full write-off in this year, meaning that the government assumes that all equipment has a 7-year lifespan. And if I buy a computer, the government would essentially want me to spread out that deduction over the next 7 years. But I can make an election to take it all in 1 year. And that election is called the Section 179 election. That is essentially telling the IRS that, hey, I don't want to wait 7 years to take this write-off. I need it now. So I'm accelerating the deduction, taking it all in 1 year. Now, the government allows for this Section 179 election, but the state of California does not. So on your California return, it might not show the full write-off. And so if you're buying software and you think, okay, well, that could be a form of equipment, or if you buy a cell phone, it could be a piece of equipment, you might want to take it as a line item deduction so that you get the full dollar for dollar write-off rather than spreading it over 7 years or putting it as a depreciable expense. Make sure that you are getting the full write-off because you could be losing out on some substantial write-offs on your individual or business return. Now, once again, we talked about gross income. Gross income is the first thing the IRS verifies in any audit. So make sure that your deposits match your actual 1099 income, or your deposits match whatever you're reporting. Now, when you incorporate, as a self-employed individual working within the real estate industry, you have to understand one thing about incorporating. One thing and one thing only, is that when you incorporate, it's mainly to protect your business separately from all of your other personal assets. Meaning that the most beneficial thing that you can do for yourself by incorporating is to separate your business from all of your other personal assets, like your primary residence, your personal 401k, your spouse's business, or your individual rental properties. So when you separate assets, you limit your liability across the board per asset. Now, understand about that there's 3 types of entities that you can choose. There's an LLC, there's an S Corp, and there's a C Corp. Now, as a realtor, as a person who sells property and makes commission income, the S Corporation, out of all entities, is the only known entity that can actually save you money. The LLC does not save you tax. It limits your liability, but in no way, shape, or form can it save you from paying the maximum amount in federal, state, and self-employment tax. An LLC is meant to do one thing and one thing only. It's meant to limit your liability and protect the asset. All right? The S Corporation, however, follows something called a reasonable salary requirement. So this is, what is the reasonable salary to pay, or what is a reasonable salary to pay yourself when you own a corporation? Well, at the end of the day, let's use some numbers so it's better to understand, or easier to understand. If I make $100,000 after all of my expenses are taken into account, $100,000 is my net profit. That's what I'm looking at paying tax on. As an LLC or as a sole proprietor, I pay federal, state, and self-employment tax on the full $100,000. However, on an S Corporation tax return, I pay federal and state tax on the full $100,000, but I do not pay self-employment tax on the full $100K. I only pay self-employment tax on a reasonable salary amount. So what is a reasonable salary? It's about 35 to 40% of your profit. Meaning that as an S Corporation, I might show a $100,000 profit, but I have to pay myself a W-2 out of my own corporation. So am I self-employed still at that point? No, I'm not. I'm an employee of my own corporation. And so my salary would be a $35,000 W-2, that's 35% of $100,000. And the only amount that I am paying self-employment tax on now is the $35,000 W-2. So I just saved myself from paying 15.3% in self-employment tax on $65,000. The S Corporation is a hybrid between the LLC and the C Corp. It gives you the limited liability protection of an LLC, but with the tax benefits of a multi-billion-dollar corporation. And you wonder how the CEOs and the treasurers and the vice presidents and the presidents of all of these corporations, why they pay such little tax at the end of every year. It's because of benefits like this. These benefits are available for people in this industry more than any other industry. That's what I've kind of put together over the past 9 years, is that realtors can really take advantage of the reasonable salary ruling. Remember that if you were a self-employed sole proprietor, if you just file a Schedule C on your individual tax return and you make $100,000 profit, self-employed tax alone will be around $14,000, $15,000. Sure, half of your self-employment tax might be tax deductible, but you're still coming out of pocket thousands and thousands and thousands of dollars in additional self-employment tax. And the government's not going to go out of their way to say, whoa, 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 you know, you might be better off as an S Corporation. They're not going to do that for you. I know that you wish your tax dollars were going to pay for that kind of education, but unfortunately the government doesn't go out of their way to teach you about these benefits. That's why I'm here today. All right. So the reasonable salary requirement or reasonable salary ruling is only available for S corporations. It is not available for LLCs or C corporations. S Corps are the only entities that can actually save you money, all right? So, I throw this picture up at the end of every seminar because sometimes when you start talking about taxes and about filing tax returns and what to look out for in an audit, people start to get a little cross-eyed and they feel like, wow, you know, that's information that I didn't really need to know, but thanks for sharing it. If this is not your forte, if you are not the tax-savvy person, which I'm not expecting anybody else in the room to be, this is how I get paid. I get paid to be a tax preparer. The one thing that I want you all to know is that we all have an obligated amount of tax that we pay. In some form, shape, or other, we pay sales tax, use tax, property tax. If you live in the city of LA, you pay LA City business tax. You pay federal, state tax at the end of the day. We live in the probably this first or second place, highest tax state in the United States of America. We flip-flop for first place with New York. All right? So you have to understand that when you live here in the state of California is going to want their 9.3% state tax at the end of every year. In fact, going into 2014, if you are a high income earner, you might pay upwards of 13% in state tax. Now, me personally, out of the 1,200 or 1,300 returns that I prepare on a year-to-year basis, I've had about between 25 and 30 clients already leave the state of California because of this. They moved to Nevada, moved to Texas, moved to Florida, these states that do not have state tax. But that's the lengths that they're going to in order to save them from paying the maximum amount in not only federal and self-employment tax, but also state tax. If you move your business, I'm not telling everybody to get up and move to Nevada, but if you move to a state that didn't have state tax, like Texas or Florida or Nevada, you'd be saving yourself 13%. Now, these people still do business in California, but as far as their payroll is concerned at the end of the year, they are not paying individual state tax anymore. And in their income levels, it was beneficial to do that because you're talking about people who are making $500,000 and upwards per year. And that's 13% savings for them. But understand this, at the end of every year, California will come for their tax liability. They think they're Uncle Sam, all right? So not only do you have Uncle Sam to pay, but you have the state of California, and you also have your self-employment tax to pay, or your Social Security contributions. If you have ways to shelter income for your business and to save you from paying more than your obligated amount in tax, take advantage of it. Take advantage of it. It might cost you a little bit more here in the state of California to be an incorporated entity, but there's an important calculation that needs to be done at that point. Is it going to save you more than it costs you to be a corporation? If it saves you more than it costs you, would that make sense? Yeah. Absolutely. If it's going to cost you more than it saves you, sometimes it doesn't make sense to do that because you're coming out of pocket additional money, right? It's more of an expense to you. Nobody wants to spend more money if it doesn't help them. But if you run a very high risk, if you have a lot of personal assets that are paid off, like let's say you have 10 rental properties, they're all paid off. That's as good as having cash in your bank account. You might incorporate, even though it might not save you more than it costs you, you might incorporate just for the asset protection benefits. So don't discount the incorporation question just yet. Let your accountant assess whether or not it is the right time to do that. All right. So if you have questions, we're here to help. We can review your prior 3 years of tax returns for free if you have questions. If you've been with your CPA or your EA for 30 years, if anything, take advantage of this and have a second opinion. After 30 years of being with your accountant, what's the harm in having a second set of eyes on your tax return? That's what I tell everybody. I'm not saying that you should leave your accountant after 30 years. Bob Hall's had clients with him for 42 years. There's no way would they ever leave him and go see another CPA or an EA. But I would suggest, hey, listen, if you can have a second opinion from another CPA, just to make sure that your accountant is doing things correctly and that he's keeping up to date with what your industry needs filed on your individual or business tax returns, take advantage of it. Okay? So we do a review of tax strategies, and we'll also send you periodic tax email updates to put you to sleep at night. Those are really, really important emails. They're very, very good to read while you're falling asleep. I'm not kidding about that. They're very dull subjects, but it is very important to understand what to look out for moving into 2014. Now, in the real estate industry, I'm going to share one more thing with you before I wrap up. Moving into 2014, everybody understood that at the end of 2013, the Debt Exclusion Act of 2007 was going to expire. They've been talking about extending it and extending it. There are still ways to take advantage of the Debt Exclusion Act, meaning that if you short sold or foreclosed on your primary residence and you had cancellation of debt that you didn't have to pay tax, there are still ways to get around having to pay tax on that money. If you have a good CPA or a good enrolled agent, they will know how to apply certain deductions against basis in your property to avoid paying the cancellation of debt tax. even if the Debt Exclusion Act of 2007 expires, there is still relief for people who are losing their primary residencies. So have them talk to a professional. Do not try to give them advice. Don't send them to Google, okay? There's a million people on the internet and they're all trying to give different advice. Just like you wouldn't go to Google for medical advice, right? Don't go to Google for tax advice either. So if you feel like you need a free consultation, I have these little forms. They look like this, okay? I'll stick around afterwards to try and answer all of your questions. I know that most of you are off to do business. That's what you do best. If you want to pick up a form from me, I'll be up front here, and I'll also try to answer all of your personal questions as efficiently as I possibly can. So thank you for having me.